One of the big things with this is, depending upon where you are in the seed to sale process of cannabis, determines how much you can and can't deduct your expenses.
That's
correct?
exactly correct, yes.
Hello there, welcome to Capitalizing on Cannabis. We are going to be talking about 280E and the impacts of that IRS code on our cannabis businesses. So this is an accounting issue, so I have an accountant, a CPA here to help talk about this topic. His name is Bruce Andersen. He has his own firm and he focuses on the cannabis industry. Not only is Bruce a CPA, he's got an MBA, he's got a master in tax, he is a former military, an Army officer, and a specialist in systems as it relates to accounting, which is very important in the cannabis industry.
Absolutely.
Right?
It's one of the areas, since it is a highly technical field, to make sure you have an understanding of how to put the systems together that will give you the best results. Very important.
Right. And the systems are a big deal when it comes to 280E in making sure that we're putting our expenses in the right buckets from a tax standpoint.
Absolutely,
Right?
because the cannabis industry is under this 280E restriction, so therefore cost of goods sold work fine, and operating expenses are not deductible. So it's a big deal.
Correct. All right. So what are we talking about? We are talking about Schedule 1 drugs, which cannabis at the federal level is still a Schedule 1 drug. We're talking about the tax code implications of working with the Schedule 1 drug, which is 280E of
That's
the
correct.
Internal Revenue Code. And we're talking about the things they can deduct versus the things they can't deduct.
That's correct.
Which is the cost of goods sold.
Yes, absolutely.
Okay, so let's get into this. One of the big things with this is, depending upon where you are in the seed to sale process of cannabis, determines how much you can and can't deduct your expenses.
That's
correct?
exactly correct, yes.
So let's talk about that.
Yeah, so when you're speaking about the four parts of the industry, growing and manufacturing are good parts of the business for good 280E deductions, cost of goods sold. But when you're selling things, whether it be on the distribution side or on the retail side, then you're extremely limited primarily to only the cost of goods, just to the inventory cost itself.
Right.
And other parts of the business are generally non-tax deductible.
Things that an average business would be able to deduct,
That's correct.
they can't deduct.
Yes.
And so where does this come about? How do we get to 1080E?
So 280E is
280E,
part of the
sorry.
Controlled Substance Act. And it's very interesting. I've been in meetings over the last several years. I've been involved in this, and people go, well, just get rid of 280E. And it's like, well, you really don't want to do that, because there are drugs that should be restricted as far as, that really are bad drugs, that really should be restricted as far as their income tax reporting capabilities. But as long as cannabis is sitting as a Schedule 1 drug, then 280E continues to apply.
Right. So the thing that's going to be required for this to change is a change in the scheduling of cannabis.
That's correct.
Right. A Schedule 1 drug is a drug that has no medical purpose. And from a government standpoint, no medical purpose and no value from a research science standpoint.
That's correct.
The information and data we have today is pretty clear that cannabis is not properly scheduled.
Yes.
But until the government decides to move it, we still have this
We're
problem.
stuck with where we are.
Right.
Yes.
And that's where, this has become a challenge from a legal standpoint, because you've got states who have decriminalized cannabis and no enforcement from the federal government to stop that, but it's still a Schedule 1 drug. So we're in this kind of quasi-legal world where we're trying to manage these.
And what happens
businesses.
is that because of the repercussions of federal not being legal, then the banks say, well, we're not going to touch this, because what happens is federal say, well, if you're going to get into the cannabis space,
Right.
then we're going to remove the ability for you to be insured federally, and we're going to also do some other things which end up deterring banks from
Right.
wanting to participate.
Well, so there isn't enforcement from the Department of Justice as far as, going after these dispensary, you open a dispensary and you can do business and no one's coming for you, with the handcuffs. But on the banking side, the banks are still being regulated. The Department of Treasury is still enforcing the rules as it relates to banks. So they are at risk potentially of having those issues. So the banks are protecting themselves, and the result is that banking becomes a real challenge for our cannabis-related businesses.
Yes, and what's happened is the non-bank financial institutions have a breath of fresh air for them to participate into the cannabis space. A non-bank financial institution is one which is FinCEN qualified, meaning they have the same rules as federal banks and so forth do. But as a result, they are going through a process where they vet the vendors that are involved. There's also a contingent of state-regulated credit unions and so forth that also will participate in the cannabis space because they don't have to abide by federal rules.
Yep. So there are some banking options available for people in the cannabis space, but they are limited. And there's definitely a vetting process that goes into opening an account if you're a cannabis client.
It's a very interesting process. I, of course, have several clients that have gone through this process. What happens is that they think they're getting kind of the third degree, and it's like, well, I'm sorry, it's just that the industry does not have a good reputation, so therefore they have to make sure that if they're actually paying out somebody through their system, their non-bank financial institution, that these people are actually a party, that they are actually participating in the industry on a legal standpoint. They're providing products, they're contractors that are helping you build out your facility and so forth. So it's a very interesting, challenging area.
Definitely. So with 1080E in place, I'm sorry, 280E, I don't know why I keep doing that, but with 280E in place, what are we talking about as far as our cannabis business? What does it really mean?
So what happens is that you have to stratify your expenses correctly so that if you are again, in a growing or a making mode, then you have cost of goods sold, which is very similar to other either agricultural industry participants or manufacturers, where you have major components that are just part of the process of making stuff. So it's a material cost, it's direct labor. The third layer is actually other direct expenses. And we're going to get into those on each of the different verticals, parts of the industry itself. The other part of it is quite challenging in that you may have a facility that is more than just one license. So, for example, you may be in a position where you're a distributor and a manufacturer. Distribution has literally no cost of goods sold other than the cost of completed products, whereas the manufacturer has the whole complement where they've got materials, they have direct labor running machinery and so forth, and you have other direct expense. So therefore you have to have a good solid accounting program in order for you to capture those expenses correctly.
Right, and even segregate your areas of business, right? If you're a micro where you're doing multiple layers of the business, the same expense, payroll, for example, can be in one bucket at one stage
deductible
of the process
in one and not in another.
Right.
That's right.
Yep. Okay. So as we talked about, as we're looking at the supply chain of cannabis, so seed to sale is the common terminology. From seed to sale, you become less able
less
to
deductible.
deduct expenses, right?
Yes.
So let's talk grow, right?
So we're going to cover those in more detail in just a little bit more. So I think that, again, growing is something where you have to be able to start from whatever stage you have, whether it be clones or whatever, and be able to actually get to the point that you have a product that you can harvest.
Right.
Okay.
So that's the first stage. The second stage is the manufacturing.
Manufacturing can come in several forms. It could be actually buying, now instead of calling it cannabis, they call it biomass, because that's what the term is, that now is raw materials for a manufacturer, and they can turn it into a variety of products. It also may be that you start with fresh flower and you do some other configuration to it. In the state of California, you have to have everything prepackaged now. So therefore, you have to move from a cultivator into a distribution mode. They are the ones that will typically be packaging our products, which then go to market.
I'm hearing the term crude used as well, biomass and crude.
Yes.
Yeah.
Interchangeable.
So, it's interesting words we start to learn in our new home here in cannabis. So grow, manufacture, distribution, right?
So distribution is a concept that is specifically in California and some other states as well, but it depends on the state you're in as to if the distribution takes on the same magnitude of importance that it does in the state of California.
Right.
But basically, you cannot move your product in the state of California. If you're a cultivator, you cannot move your product yourself. You have to have a distributor that's involved. If you then have your product in a distributor facility of some sort and you need to move it to retail, you then again have to call upon the distributor to actually pick it up and move it to a retailer.
So they control not only production, but movement.
General movement, yes. Yes, it's a very complicated process. State of California now has had a system called Metric in place now for several years. It actually manages any time the product moves. There's 18 touch points that are involved. If you're going to be a full micro doing everything from seed to sale, it will be potentially up to 18 touch points, which includes actually any kind of waste removal as well. So it used to be that was kind of the soft spot for product to be able to kind of fall off the table and somebody distribute it in some fashion which is not according to the license that they hold. And now that has been closed up with their ability to manage the waste, also reporting to state agencies.
Right. And then again, our last piece is our retail.
Retail, of course, is the final touch, which is instead of going to CVS or Rite Aid, then you're going to go to the dispensary, and the dispensary then is going to have whatever products are available for sale, and they then are the last touch to get in the hands of the consumer.
Got it. And then we're going to categorize our expenses. Every business has expenses. I have expenses. You have expenses, right? I don't sell anything, thank goodness. I don't manage an inventory. I can't even imagine. But there are different types of expenses. Not every expense is created the same.
Right. So it's quite interesting where, again, we've harped on cost of goods sold as that part of the deductible area. But just think about if you're in a community that has retail dispensaries and you see these big billboards up on up along the highways or the city streets and whatever, those are very expensive and non-deductible.
Right.
Okay. If you're in a dispensary and you see all these very helpful people, which we in the industry call bud tenders, all their payroll non-deductible. The rent associated with distribution, with dispensaries, non-deductible. Okay, so therefore there's a very high cost to the industry to have all these expenses, which you basically have to have, but yet not deductible.
Yep, because you still have to do everything a business has to do. You have to market, you have to have staff, all those things have to happen, but those costs are not deductible.
Well, and I think the most interesting one is where I have, whenever you get into a particular industry area, you have your collective of resources that you meet with periodically. And there's one tax attorney. And so early on I said, now it doesn't make any sense that the distributor is not getting deductions for drive around the car. And she says, well, that's the ultimate example of you being in a business and basically doing illegal activities. You're trafficking. That's a term that's specifically in the code. And now you're saying you can't deduct a trafficking thing? So that's where it's just so bizarre with regards to those things are deductible and not.
Right. And it goes back to the Controlled Substances Act, the regulation, that drives all of these different things.
Absolutely.
Right. So let's talk about our different people in the seed to sale process and how their world changes as they change into these places.
Sure.
So let's start with the grower. Obviously, that's the beginning of the process.
Sure. So with the grower, then again, we've got three major categories of expenses: material costs, direct labor, and other direct expenses, direct costs. And so with the materials, it's going to be nutrients, it's going to be clones. Any of those kinds of things that go into the actual growing of that product are going to be tax deductible for the grower.
Got it.
Next thing is direct labor. Many times people say, well, now I've got an owner that we can't deduct their wages. Well,
Right.
what is that owner? Is that owner the master grower for that facility? If so, then a portion of that individual's wages are going to be tax deductible.
Got it.
Additionally, then, for any of the trimmers that are involved with the harvest process, anybody else that's maintaining the harvesting phase or the growing phase, those are all tax deductible, and everything that typically comes along with that. So what do you have typically with a labor burden? You're going to have payroll tax expense,
Right.
workers' compensation, any kind of insurance that you're offering to the employees themselves.
Yep.
All those are going to be good direct
grower.
expenses for cost of goods sold. Other direct expense. So now we have the rent facility, all your water, utilities, electricity, and so forth, building insurance and so forth. All those are good cost of goods sold deductions
Got
in
it.
the grower side.
Perfect. So that's not so bad, right? You know.
It really isn't. In fact, if a business is structured well, especially in the area of growing, then you shouldn't have a whole lot of overhead expense anyway. I mean,
Right.
what do you have that somebody needs to do there?
Yeah.
So therefore, the bulk of a grower's expenses are tax deductible.
Got it. So let's talk about one of your growers and kind of how are you able to structure their expenses?
So we take a look at what their facility is. We first ask them what their licenses are.
Yep.
If they have only a growing license, grower's license, and then we say, look, that whole facility is going to be something that we can start to work on with regards to cost of goods sold.
Right.
The area that starts to get a little soft is that most of these growers say, look, I don't want to be dependent upon somebody else for my distribution component, so therefore they will generally have a distributor's license as well.
Got it.
So with that, then all of a sudden you start to break out those expenses that are associated with distribution versus the cultivation side.
Right.
The big thing, of course, is labor, because that's such a huge part of this industry, is to make sure that that labor component is managed correctly.
Right.
We also have the inventory itself. So we've talked about what it takes to make stuff or grow things, but now you have to actually manage that inventory that's associated with it as well.
Right.
And now in the state of California, you have to have month-end inventories that the state can come in and look at to make sure that that will give them the ability to reconcile the industry as a whole with
Right.
regards to how much product is moving through.
Got it. Got it. Okay, so that's our grower. So our next person in the supply chain, our manufacturer.
That's correct. So with the manufacturer, now what you have to think about is, and again, you don't have to be specifically associated with cannabis to get a good feel for how this stuff starts to work. So I usually give examples. So if you're a manufacturer that is producing a product that goes in a jar, then everything that is associated with the original raw material,
Yep.
the jar itself, the labeling, the lid, the corrugation that goes around that, all that stuff is going to be good tax deductible areas.
Got it.
Okay, for the material side of things. Direct labor, now what you have are those personnel that are associated with that manufacturing process. It could be anyone who is lower skill level that is actually doing the packaging of the completed products into corrugation. It could be a higher level of engineers that are actually running those machines.
Yeah.
In the grower side, I mentioned a master grower as also an owner. Well,
Yep.
now you have to be very careful that you don't expand yourself too much to the point that you're dreaming up reasons to have owners' wages also being tax deductible.
Right.
If somebody's heavy duty in the manufacturing process but is just an owner who basically is sort of a project manager kind of person, then you may not want to be as aggressive with regards to the write-off of that individual's wages.
Got it. That makes sense.
And the third area, again, is as similar as what we had on the growing side, which is the rent, utilities, business insurance, and so forth, which are going to be good tax deductible items.
Got it. So at that stage, we're still able to deduct most of the expenses.
Most of the costs of a well-run grower manufacturer are going to be tax deductible.
Perfect. So now we've got to our distributor, our trafficker.
That's right, the true trafficker in this whole thing.
Yes.
So in this case, if you're selling things, then you really have to be very careful about being overly aggressive. Generally, the safe zone is whatever the cost of products are that you're acquiring and in your process that you in turn are selling. That's a really totally safe zone.
Right.
But if you then think about what it takes to be in the distribution business, you may have some space that's allocated to distribution. You may have some person that's involved with inventory control.
Right.
And you have to say to yourself, how can that product just arrive at a spot and get onto that vehicle so that they can actually deliver?
Yep.
There has to be somebody involved. But again, you have to be very careful that you document what their duties are, how they're actually participating in that business. If there's a lot of split use of people, then sometimes that's not a direction that you want to push very hard on.
It's not worth taking that risk.
It is not worth it.
Right.
No.
Okay. So so material costs, not a lot when we're a distributor, right?
Everything that you're selling or reselling is deductible.
Yep. Okay.
Yes.
Labor, and then what about our other direct costs?
So other direct costs, you're going to have a small portion of a facility. If in fact you've got a shared arrangement, if in more than one license, then
Right.
you're going to have a shared arrangement. If you're only a distributor and your whole facility is distribution,
Right.
then we have to really think about, are we being overly aggressive to say that there's no general administrative operating expenses going on there,
Right.
or are we pretty comfortable that this really is just like a major company distribution hub?
Got it.
Okay. The one thing that's difficult is that trucks, because that's part of the trafficking
Yeah.
thing, not deductible.
Right. So the actual vehicles are not going to be deductible. The costs and maintenance and all that.
Not deductible.
Right.
Right.
So, and that may be one of your biggest costs as a distributor.
Oh, of course.
Right.
Of course.
Ensuring that, all of it.
Well, and I've just sat in on some discussions about we need to, in a distributor's environment, we need to look good when we're on the street. We can't have old clunky cars. Well, so what are they doing? They're buying fancy, nice
Right.
vehicles,
Right.
vans and so forth that are not inexpensive.
Yeah, exactly. All right. So now we get to the end of the line, the dispensary.
Dispensary, so we have material costs, which again are whatever there is for resale.
Yep.
And because of the way that Metric works, which is a state reporting agency, there's the ability to actually manage the amount of supply of product going through the chain.
Okay.
So therefore, you can't play a lot of games with this. The additional thing is that not only do dispensaries pay sales tax when they're actually selling the product,
Right.
but they also have to pay excise tax when they're receiving the product
Right.
in. So therefore, the state has their kind of hand into that as well to help establish what that markup is for product.
Right.
So therefore, you really have to toe the mark with regards to having a good accounting system that
Yep.
will help you manage that material cost. But again, it's actually the product available for resale. Similarly, with regards to distribution, if you have somebody that's involved in the inventory management, then they are pretty good with regards to being a cost of goods sold
Okay.
item. Also, whatever your cage facility is that stores the product, that also is a pretty reasonable expectation that is going to be a good area for a tax-deductible cost of goods sold.
Got it. But the actual retail facility and those types of
All
things.
those pretty display cases, all those drop-down lights, all that fancy stuff, anything that looks like, in fact, the example I give is, if your shop was a jewelry store, a high-end jewelry store, just X everything out. Just take everything that you spent on that and say non-deductible.
Right.
It's that simple.
Yeah. And that at just dispensary level, at distribution, that's when you're going to be marketing to the public, right? Out trying to.
So when you're actually at the retail side, dispensary, that's what's going out to the public, and that stuff, unfortunately, they say is not good cost of goods sold.
Right, right. And on the excise tax, you kind of mentioned that. My understanding is that the tax happens at different levels, but that it's collected and put at the dispensary level to actually pay it to the tax man. Is that right?
So when you, so very good question. With regards to what does the consumer pay for, they have to pay for the original cost of the product.
Right.
They have to then pay the excise taxes that's been paid on that product. And when they get a receipt from the retailer, it has to identify either the amount of excise tax paid,
Yep.
or it has to say excise tax is included in this purchase price.
Right.
Okay.
Yep. So all that is documented at that level. So let's talk about your dispensary client, a dispensary client, and kind of how you help them with their accounting to comply with 280.
Yes, so the biggest thing is really focused around inventory management.
Yep.
When we have build-outs that always occur, then what happens is you've got to be able to say, okay, so how much of this is as if you were a retail jewelry store,
right,
and all that stuff's non-deductible. And then what you have is also the ability to have those components of that business which are in a fashion that they are associated with inventory. Now, there's also some planning techniques associated with the taxation as well, where if you ask people, when is the 280E going to be non-applicable to the cannabis space, then they say 2 to 5 years.
Right.
Okay, so if you take a look at a lot of the assets that you're putting into play with regards to the dispensary, then to do aggressive 179 expense deduction, bonus depreciation, why would you do any of that? Because it's not deductible.
Not now.
So therefore, what you do is now you take a look at federal standards for assets, and sometimes you have things even like computers where you say, computers, we replace them every year, so therefore, do we even need to capitalize? Well, the cannabis business, you take the other approach, which is what is available to capitalize, and what is a good long-term value, an appropriate life to this. So it may be 5 years. Maybe some types of technical equipment could be 7 years.
Right.
The other thing is you do this on a straight line basis, because hopefully by the time the 280E is not applicable anymore, you'll still have assets on the books that have some value that now you can do tax deductible things with.
There's been movement in Congress to try and address this. The House has passed a couple bills. We're stalled in the Senate. And I don't think it will happen this year. We got an election going on. But there's no question that within the next couple of years, it almost certainly will happen. And so planning for that and giving yourself enough, as much as you can when it does happen, it makes a lot of sense.
Sure. I mean, you've spent the money. So now are you going to be so short-sighted that you can't differentiate your cannabis tax accounting from other more traditional accounting?
Right.
And you have to put a cannabis tax hat on to be able to do this correctly.
Correct. So what are we talking about as far as recording? What are some of the recommendations?
So the important thing is that you don't do all of your tax accounting in the last month of your fiscal year. Okay. So if you're a calendar year, which many businesses are, you don't do all your accounting in December, because that doesn't show that you used extemporaneous accounting for this work. You basically need to make sure that month by month you record your transactions correctly. The other thing is that with regards to the way in which you do your allocations, which can be either personnel or we talked about cost of goods sold that are deductible versus non-deductible, you want to make sure that you first do your posting to the cost of goods sold account, and then if you want to take a haircut and take away some of that and put it into your operating expenses, that at least puts the core transaction into cost of goods sold, which again is, for a non-accounting person, non-tax, it's like, well, what difference does that make? It makes a big difference with regards to auditors coming in and doing that kind of thing.
Right.
The other thing is to make sure that you classify by part of the business, whatever part of the supply chain you're in, that you take advantage of that as well, and you can actually show that you have separate business activities going on.
Got it.
If when you are done with your accounting work, you kind of just shuffle some entries back and forth and say, oh, I forgot to do this earlier, I'm going to do it once a year, that ends up not being the kind of core, solid records that you'd like to be making.
Makes sense. Makes sense. So one of the recommendations in accounting for a cannabis company is using an accrual basis of accounting versus a cash basis.
Yes, and so many companies at the smaller size are always used to cash-based accounting, and it's like, but it doesn't fit well.
Yeah.
First of all, inventory is a concept which generally is more associated with accrual, so that's your biggest hit. The other thing is that if you take a look at the way in which cannabis businesses operate from a standpoint of sales versus collections of money, many times it's a cash and carry, especially on the dispensary side.
Right.
So therefore, for you to move to an accrual-based accounting is hugely advantageous because the cash side of things, the revenue side of things, may be very close to the same whether it's cash or accrual.
Right.
So the pickup for the cannabis operators to be on accrual-based accounting, so therefore they have the ability to accrue for their accounts payable, for them to take a look at the way in which they manage accrued expenses and so forth. There's a lot of advantages which again, I'm looking at the perspective of 2 to 5 years. What kind of stuff do we have to continue to do while we have 280E?
Understood. Cost of goods sold is something that is also a part of this, and making sure that we have the ability to properly document that with accrual basis versus.
Sure. So the big thing is are you managing all of your cost of goods sold in a fashion where you can distinguish and delineate the fact that you have acquired product, you've completed transactions, whatever, and oh, by the way, maybe they're not paid for. Well, guess what? That's where accrual basis accounting comes in, so therefore you can actually get more expenses for your tax purposes when you do a nice job at accrual accounting.
And also just a better financial picture overall with accrual accounting, correct?
All public companies are on accrual basis. There's nobody does cash. It's back to the accounting concept of matching revenues and expenses, and to do it on an accrual basis just makes perfectly good sense. The fact that you're cash short for 2 months and you didn't pay your bills, well, that causes huge distortions in what your financials look like on a cash basis.
Right.
On accrual basis, you still have really good P&Ls.
Got it. So accrual basis accounting, we talked about. Preparing the tax returns on that accrual basis.
Absolutely.
Not only maintaining it, but the tax returns done in that fashion. Very important. So
the other thing that I'd like to bring up is with regards to if you have investors, if you have people that are outside, if banks come around,
right,
or if you have non-bank financial institutions, if you have vendors, they're going to want to see financials. Some are all of that group.
Yep.
So therefore, what people are used to is accrual-based financial statements.
Right.
That's what people present when you get into a bigger platform and an arena. So therefore, for even the startup companies, it takes a little bit more to get going and to get the concepts put together correctly. But after those accounting standards are established and the procedures are established, it's not harder to keep an accrual set of books.
So once you've got it set up, it works as well and as seamlessly as a cash basis.
Same, absolutely.
Right. So booking taxes.
So this is something where taxes, as we've talked about, is a big deal, whether it be on the federal level, state, or local. And so this is where to use accrual-based accounting is that you're going to book that expense, which is going to be taxes.
Yep.
And likewise, you're going to have an offsetting liability. Well, that's a huge thing for owners and those that are going to be the taxpayers of those expenses.
Yep.
Because so as you're moving along, month by month, even week by week, if you're using accrual-based accounting and booking those taxes correctly, then the owner or key operator can look and say, oh, guess what? In another 6 weeks, I've got this tax bill to pay.
And you have the money set aside.
That's right. That's only available in an accrual set of books.
Got it. And again, all of this starts to look our balance sheet and how important our balance sheet becomes. The accrual basis will make that more seamless and usable data, correct?
Yes, I think that we focus a lot on the profit and loss statement, but in order to reconcile your accounts, in order for you to have really a true picture of what your business is doing, you've got to have this thing called a balance sheet. And sometimes there's such an emphasis on P&L that the owners, operators don't have a good understanding of what the balance sheet is.
Right.
So that's where the accountant's job is to, again, expose them to a balance sheet, make them comfortable reading them, make them wanting to read the balance sheet.
Right. So keys to accounting for a successfully accounting for a cannabis business. Okay. Right? So electronics. Right.
So you have to have one database that this stuff is coming from. If you walk into a business and say, let me show you my Excel sheets, it's like that's the wrong answer.
That's a bad start.
Yeah, that's a very bad start. So get an electronic accounting system, get it set up correctly so that you have one database for all your information to be coming out of.
Right.
Next area is going to be actually categorizing the expenses, so therefore we have good, clear differentiation between not only cost of goods sold versus other operating, but also across the different parts of the supply chain.
Right.
So you can differentiate, this is part of my business as a cultivator, this is a part that's a retail, as an example.
And then we talked about accrual method and actively monitoring our balance sheet.
That's right.
Right. So where does the CPA fit into all this?
So the CPA has traditionally been accounting and tax, okay? But in the career of pretty much all CPAs, they've had to do some work in the audit field. After the audit's completed, the next thing they're invited to do is fix things they found out about, and so therefore they get into that business consulting area.
Right.
The financial planning is a huge area. You know, accountants have been generally into that historical cost accounting area, but then as soon as you have your cost accounting done and you're ready to start looking to the future, then the next thing you're going to be doing is doing a financial plan. Let's see if we can do a budget. Let's see if we can do a sales plan moving forward. The other thing, and the last thing that we're going to talk about here, has to do with the fact that you've got to make sure that you just don't have a good, solid, general purpose accountant person, but somebody has industry experience.
Right.
And that's something that goes way, way, way back to say that if an accountant, CPA, takes on an engagement, they're supposed to have industry experience. And so this is where it's just much more important with the cannabis space than anybody else.
Right. It's uniquely situated.
It's uniquely situated and continues to change.
Right. Right. So big takeaways, categorizing our expenses.
Make sure they're all categorized correctly. Yes.
Following proper accounting standards.
Absolutely.
And again, using a knowledgeable accountant. Right?
That's correct.
Those are the core things to do this well.
Yes.
Great. All right. So, Bruce, let our audience know how they can reach you.
Sure. So my firm is Andersen CPA, but I branded my part, which has to do with cannabis space, as CannabisCPA.tax. So feel free to go there, and from there you can get in contact with us. We're very happy to take on new clients or anybody that has stress or issues with their existing situation. So it's be a pleasure to meet all of you.
Great. So thank you so much for watching our video. Thank you, Bruce, for coming out and doing this.
Thank you very much.
Really appreciate it. This has been Capitalizing on Cannabis. If you like this video, you can press the like, or you can subscribe to our channel. We have several different topics that we're covering, so glad to be here and glad to talk to you, and hope to have you watch one of our videos soon. Thank you very much.